Good morning, YouTube. Matt here from Shoe Capital. On this channel, I talk about all things personal finance, investing, and real estate. Today's topic is lazy investing that creates amazing results. Have you ever not wanted to spend a lot of time thinking about your investments, but make sure you're set up well for retirement? The most common way people do this is with an S&P 500 index fund. So the number one factor here is what type of returns are we going to get that will hold your interest, right? Since 1957, the S&P 500 index has averaged a return of 11.8% annually. Now, some years it's down and negative, and some years it's well above and positive, this average. But through all the wars and other major calamities that happened over these past decades, we've averaged 11.8%. Now, the first thing you're going to need to do is come up and find a brokerage account. This can either be through your work, where you have a 401k, and they'll provide the brokerage account for you, and then you just link contributions from your paycheck to go into this. Or you can get your own brokerage account, either personally with a spouse, and this is where you can set up a taxable or non-taxable account. Some of the most popular ones out there are Robinhood, M1 Finance. If you like more traditional, there's Vanguard or TD Ameritrade as well. They all offer $0 trades. Some of their fees are built into the bid spread, but that's not too much to worry about for the size of trades we're doing. And then you just need to pick your index fund. And I really like exchange traded funds because they're very liquid. You can sell them very easily if you choose. And they also have very low expense ratios. So you want to get this type of performance, that 11.8%, but pay as little as possible to the companies that provide you that service. But you definitely want to be confident that these companies are actually going to perform and be there for the long term. So in 40 years, you won't have to mess with it much. So some of the biggest names in the industry are State Street. Their ticker symbol is SPY for their S&P 500. Vanguard is also another popular one. In fact, they invented the index fund. Their ticker symbol is VOO. And a new entrant in the space, iShares, their ticker symbol is IVW. And the expense ratios vary for each of these. They're usually a couple basis points. So for every $10,000, you might pay, $10, $20 a year in management fees, which are really low, particularly compared against the traditional brokerages that do active management, where those fees can be in excess of 1%, 2%, or even 3%. So let's do a quick example using the compound interest miracle that exists and assuming this 11.8% average return. Again, some years it'll be higher, some years it'll be less. And let's assume a modest contribution over time. Let's say $200 a month. So say either from your paycheck through your 401k withdrawal or through some personal savings you can achieve each month, you're able to save $200. Great. Doesn't sound like a lot up front, but as we walk through this example, you'll see it'll compound to a significant amount. So you're contributing $200 every month to a brokerage account of your choice, and you're going in and buying the ETF. Let's do SPY, for example, that gets you full access to the S&P 500. So you'll get some shares, and you'll let it sit, and you'll keep doing that every month. $200, buy the ETF, $200, buy the ETF. Very boring, just keep doing that over and over again. Most accounts you can automate this, so you won't have to actually do anything yourself. You can either link your checking account or through your 401k withdrawals from your paycheck. This can be done automatically. So let's go through some numbers. So you're doing $200 a month. That's $2,400 a year, so 200 times 12. After 10 years, assuming this average return, you will have $46,000. Okay, that's a great start. You're not necessarily walking away from your job just yet, but you're making some momentum. After 20 years, we're at $188,000. Starting to pick up some steam here. The snowball's getting bigger. It's doing better. After 30 years, you're at $622,000. All right, that's getting really exciting. We're more than halfway to $1 million. And we're starting to see the potential of how we could really live off this with a pretty nice lifestyle. And then after 40 years, which is about the typical length of a career, give or take, in the United States, you're at $1.947 million. That is a nice nest egg. And assuming you're doing a 4% withdrawal, you could withdraw from this amount indefinitely and never run out of money, assuming average returns consistent with the past decades that we've talked about. So let's think about that example real quick for a second. So 4%, that would be 20, 40, 60, 80K. So 80K just from this investment every year for the rest of your life to live off of in retirement. And that's not counting anything you'll get from Social Security, pension, or any other investments you might have in your portfolio. So again, in review, if you like the lazy investing approach that gets great results, definitely consider an S&P 500 fund as part of your overall investment strategy. Since 1957, we've averaged 11.8% average returns. It's going to be negative some years. It's going to be fantastic and above that other years. But if you've got the stomach for that volatility, you can get some amazing results over the long term. So definitely set up your brokerage account, check out the S&P 500 funds, and go make yourself rich slowly over time through the miracle of compounding interest. That's all for now. Please like and subscribe if this content helped you, and check out my other videos that will help you reach your financial freedom and your personal goals. Thanks again. Bye.